The Money Show.
Investment School.
Well, The Money Show with Bruce Whitfield is brought to you by ABSA CIB. Access the world with ease with ABSA's Forex expertise. ABSA is a registered FSP. So I hope you have a paper and pen, or if you have maybe a laptop in front of you, or maybe using your phone and you want to take down some notes. Gary Booysen is our headmaster today in our investment school, and we're talking structured notes. What are they, and should you be investing? Welcome again, Gary, for joining us in our investment school today.
Yeah, thanks for having me on.
Structured notes. If this was coursework, this would be like higher grade that you're teaching today in terms of investing. So I'd like you to break it down for some of our listeners who wouldn't know what a structured note is and how one can get into it.
Okay, I'm going to try and make it as simple as possible because these can get fairly complex. I've got quite a simple example of one today that we can chat about. But essentially what a structured note is, it generally runs under a bank's note program. So it's a bank essentially promising you an investment return. It's that simple. And the investment return can look like almost anything, depending on what the bank is willing to do. So the one that I'm going to kind of discuss tonight is a fairly simple one. So what I want you to think about it is comparing it to a normal ETF, so a normal market-linked investment. And I'm just going to make it really simple and make it S&P 500, for example. If the S&P 500 goes up 10% and you've bought an S&P 500 ETF, or you've bought exposure to the S&P 500 index, you're going to get 10%. If the S&P falls by 10%, your account is going to come down by 10%. So that's a linear product. Very simple. You buy it. If it goes up, you make money.
There's risk. If you gain, you gain. If you don't, you gain.
And if you don't, you don't. Now, typically, if you're buying into the equity market like an S&P 500, that is considered high risk in investments. The lowest risk investment that you can have is a risk-free rate. It would be essentially buying, a government bond, like U.S. Treasury.
That's very conservative.
Conservative, or a bank account in layman's terms. You're putting it in a bank and you're going to get an interest rate. And the interest rate's not going to change. It's just going to get your money every month. Now, what a structured note does is it's kind of halfway between the two. So it's not high risk, but it's not low risk either. And in the example of the S&P, where the S&P 5 goes up 10%, you can go up 10% or down 10%. Here you can create whatever payoff profiles you want, and it's not quite your choice, because to actually build one of these notes, and we've been building them for years now, you need about $500,000. So not something that every man on the street can just I'll just go and buy.
That's steep.
It is steep, yeah. But
someone would say that's like for the big boys, but essentially, if I'm hearing you correctly, if I'm getting a structured note, I'm getting surety from a bank as well that if the risk goes against me, then there's somebody to cover me there.
100% right, 100% right. So in the case of, like constructing a note, that's a bespoke note where you go to the bank and say, hey bank, I would like my note to do all these fancy things. They'll say, bring me about $500,000 and we can do what you like. But for most people, that's not the case. So you get a whole lot of kind of off-the-shelf products. You're not going to Coca-Cola and saying, hey, can I please have these ingredients in my drink? You're just buying one off the shelf. It's a pre-packaged ingredients. So the one that we're talking about today, you get both an enhanced upside, but you get protection on the downside. So in the case of like an S&P 500 contract, if it was to fall 10%, generally you would lose 10%, but in this case, you get all your money back. And the bank is basically giving you insurance on the market falling over a period of time. So they're normally fixed term investments. So it's normally, either 3 years or 5 years. Again, you can kind of, it depends on which product you're buying. But let's say this is a 5-year term. If at the end of 5 years, the market is down 39%, you will get all your money back. You don't lose anything if the market falls. On the other side, if it goes more than 39%, then it turns back into that ETF. And so if it's down 50%, you're going to be down 50%. But obviously as well, bank guarantees, you've also got to think if like an index.
I'm looking for the catch here.
No, but if you're looking at an S&P 500 contract, lots of them will give you 100% guarantees, but you've also got to think, in a world where the S&P 500 is down 90%, does that bank even exist anymore?
No.
You're talking about maybe a zombie apocalypse at that stage.
But why do investors then love these structured notes? What's so good about them?
Yeah, so on the one side, it's obviously the downside protection. So if the market falls, you get all your money back. You've got that insurance component, which lowers the risk. So for people that maybe you're concerned that equity markets might go up, but they might fall, and you're not sure, and you can't afford to take that loss if they are to fall. it's great because you're going to have that insurance component. But then on the upside, you get enhanced upside as well. So in this specific note, it gives you just under 2%, just under 2 times gearing. So it's 1.9 times gearing. And what that means is that if the market goes up 10%, your payoff is actually going to be 19%. So if you invest, I'm just going to use round numbers, 100,000 Rand into this product, and it goes up, 10% over the period, you're not going to get 110,000 back, you're going to get 19,000 back. So you also almost automatically outperform the market, which is great, both on the downside and the upside. So you asked where the catch is. Right?
Yeah, definitely.
So you can't just do this for nothing. So there are some catches to this, of course, and one of the catches is that we have to somehow pay for the structure. So generally, what we're doing is we're taking, if the market is up more than 76%, we're going to sell away your upside. So you're saying that in a very strong market, I'll take 76% up. So I put in, let's say, $100,000 and I've got $176,000 back. If you had invested directly in the market and the market's up 110%, you're not going to get 110%. You're going to be capped at that 76%. So you're basically saying in a super extreme good scenario, I'm going to forfeit some of that, and we're essentially selling away that profit to pay for this capital protection on the downside.
All right, take me with you then here. I guess this is why they're called structured notes, because at every point, be it 25%, 50%, 75%, there's a certain agreement between you and the bank on the structured note to say at 76% or more, you can sell off whatever the gain was. But if I do lose at under 50%, you've got me.
Sure. Yeah, 100%. So what you're doing is you're taking on the bank's credit risk. So it's also, when you're looking at products like this, it's very important to understand who is your counterparty. So who is the bank that is making this promise to you? Is it some dodgy bank from, I don't want to say Middle America now because they've just gone through a banking crisis. So is it a small American bank that suddenly might run into trouble? But what is the bank's credit risk? And there's all sorts of ways of telling this. And I think South Africans are very aware of the credit ratings agencies. We look at Moody's and Fitch and S&P and we think, what are you going to do to South Africa's sovereign credit rating next?
Junk.
Exactly. So generally you want to look at your bank's credit rating, and it's on the term sheet of the product, the fact sheet, if you want to call it that. And really you should try, we for our clients that we invest on behalf of, we would only take an A-rated and above bank. So we would only work with a Citibank or a Morgan Stanley or a BNP Paribas, one of the big multinational banks, that you have a degree of safety to know that for this bank not to fulfill its promise to you, there's going to have to be a systemic global crisis.
So you manage the risk that way. So
you're managing the risk that way. Now, of course, if you do go with a much weaker bank, you get enhanced returns, of course. So that comes down to you as the speculator. We prefer to use them at what they're designed for, which is more of a medium risk product. But you can. If you're super speculative, you can go and get some really. We've got we've got a direct line with one of the issuers now, which some of those returns are just ridiculous. And you kind of just think, if I take this, as long as they don't fold in the next 3 years, I'm going to be very rich.
Give us a sense of those returns before I get into the price point of building one from scratch.
We've repriced this exact note. We're getting, so here we get about 2 times upside with a cap at 76%. There we're talking about 3 or 4 times upside gearing with a cap, almost at 200%. So you're talking about, if the market is up, let's say 10%, you're going to get 40%. But if the market's only up 50% in the next 5 years, you're going to you're going to not just double your money, you'll triple your money. But all you've got to hope is that this bank doesn't have a credit event. So it's a much more speculative product, but suitable for investors that are more speculative.
Calculated risk. So let's say I'm someone with that $500,000 or 9.2 million Rand lying around, and I want to build a note from scratch. How do I go about that?
Well, it's a great question. And when we first got exposed to credit notes, and when I started working with them probably 7 or 8 years ago, the first thing I did is you were seeing these off-the-shelf products coming from the product providers. And before that, I was a derivatives trader, so I kind of understood the option structures underneath it. And I thought, these guys are ripping us, man. Like there's a margin in it for the bank because the bank is essentially doing it and they're laying off their risk.
The house never loses.
The house never loses. So the bank is laying off its credit risk and they're charging a fee to create it. And I thought, no way. I can build this thing from scratch in the direct market, no problem. So we went out there and I couldn't even get anywhere near their pricing. And the reason is generally the volume. So the bank, they have lines of credit, they have relationships that the average investor just cannot get hold of. And then you kind of eventually, we kind of established more and more relationships. We started getting relationships with direct issuers. And now what you do is, there's wonderful electronic systems that we just can package up whatever kind of note you're looking for. So $500,000, like I said, that's $500,000. But generally what we do is we club a whole lot of investors together. We can make that entry point much, much lower. I mean, we'll take from $10,000 now. As long as you've got enough investors that all are looking at the same theme, we just club them all together and create a single issuance. But the actual process of creating the note these days, it's these beautiful online systems. You go in and you say, I want to solve for like my growth, or I want to solve for a certain level of capital protection. I want to make it conservative. I want 100% capital protection, or I want to have, I want my gearing to be here.
Yeah.
Where will my cap be? And we just kind of plug it into the machine. We farm out those quotes to all of the big banks, and they all come back with their quotes, and they kind of say, Morgan Stanley will say, oh no, we can give you that, and Citibank says we can give you that, and we pick the bank that we like.
I have a very interesting question for you after the break. If you just joined us, we are doing our investment school feature with Gary Booysen. He's the headmaster today, taking us through structured notes. What are they? How you should be investing, and if you have 10 million rand or so lying around, why you should get into them. He's of course the director at Rand Swiss. We'll pick up the conversation after the break.
The Money Show. Investment School.
Welcome back to the Investment School. Gary Booysen, our headmaster at the Investment School today, is talking structured notes. That's another part of the investment world that you should be knowing about. He's of course the director at Rand Swiss. Before the break, I was talking about how you'll need 10 million rand to get into this, but there are other ways to skin a cat and to get into this lucrative part of investing if you are a speculator. How does one buy a structured note, let's say for a lesser amount, and also gain some of the rewards that come with it?
Yeah, so the $500,000 price tag that I'm talking about, that's more an institutional price tag where the brokers have to package up all their client flow to go and create one unique. But for the average investor, they're all over the place. So there's tons of them if you know where to look, and they're on platform. You can buy them through a normal stockbroking account. There's many JSE credit notes that are out there. The thing with them is that they're fixed issuances, so you buy them in the primary market rather than the secondary market. Now, what does that mean? So if you think about it in terms of shares, many people understand shares. Shares, when you just go onto a platform and you buy and sell some MTN shares, for example, you're buying in the secondary market. That issuance has already been created, and you're buying, someone else is selling it to you and you're buying it. So generally the way that you enter the structured product market is through the primary market. So you almost wait for that IPO. And what happens is, like you'll see many of the South African big banks create them. They either do them under, a lot of them do them under their warrants program, and they'll do almost a roadshow to investors. So you get on the right lists, you speak to the right people, and they'll say on like the 10th of August, for example, we'll be closing this note. But before that, they do a whole roadshow and they say, this is how the note works. They normally do webinars and all sorts of different things. And they do almost a book build. So they build up all the different clients and they get to their $500,000 cap, but the underlying investor for local issuances can trade as little as 10,000 rand. No problem. They buy say 1,000 units. It's not a problem. Overseas, you're probably looking at about 100,000 rand as the minimum. But the same way, there's these primary issuances. You look out for them. The only thing that I would say is they're not quite as simple as ETFs. In that many ETFs, they go through very stringent regulatory frameworks before they're published to clients, and it's fairly safe as an investor to kind of go. We've got about 60 ETFs listed on the JSE to go and buy ETFs. You're probably not going to go wrong. You might buy gold at the wrong time and the gold falls, but it's a single commodity. It's risky, but but it's not quite as risky as some of the more obscure credit notes. So I would say that, if you find an issuance and you're interested in it, I mean, you should, if you have a financial advisor, just push it past them. I mean, we're always happy to chat to clients. I mean, a lot of clients bring us structured notes. We look at them. We vet it. We look at the underlying credit risk. We look at it as if it's appropriate for the client. There's lots of ways that you can get that sounding board. But once you've done one or two, and many people kind of build up a portfolio of them over time because their expiries vary. If you're buying a 5-year fixed note, you buy 20,000 rand today, in a year's time you buy another 20,000 and you buy these 5-year notes, and eventually you've got almost this liquidity as well.
When you look at structured notes, I mean, can you break it down in a sense that a lot of people look at investing as through sectors, the mining sector, tech sector. Can you do the same with structured notes, or is it just an instrument that the bank has that they offer to you?
No, absolutely. You can really, there's all sorts of different ones. So, a simple growth note on the S&P 500, the one we were talking about, that's just linked to an index. But you can do a worst of note. And a worst of note, you could say, I have a view on, let's say, tech. And I think, NVIDIA, because of its AI exposure, and I like IBM and Microsoft and Google and those 4 companies, nothing can go wrong with them because they're all exposed to AI. And I'll say I will accept the performance of the worst one of those 4 stocks. And I just want to express a view in the tech sector. And you'll get it because you're kind of picking the worst, the performance of the worst one. They'll give you incredible gearing. You'll get like two times upside on that stock's performance. So there's all sorts of contingent payoff profiles that you can do. You can link them to commodities. A lot of people, say 3 years ago, the Euro stocks was just pricing incredibly well. So you saw a lot of Euro stocks notes coming out just because people liked it, and that's the way that the market was skewed. So yeah, there's many underlyings that you can that are on offer, and many that you can take.
And who should be looking at structured notes in terms of the investment profiles? There are people that don't like a lot of risk,
Sure.
People that have an appetite for risk. And people who are just foolish. So who should be looking at this particular instrument?
I think it could form a part of just about anyone's portfolio, to be honest, depending on the type of structure. So, and that's because some structures can be incredibly risky, and that could suit a speculative portfolio that's really trying to generate high returns given a specific scenario. For example, if you very, very bearish on commodity markets, and you want to take a note that is betting that Anglo and Billiton and Anglo and BHP, I'm showing my age. The name's changed. Anglo and Rio Tinto and Glencore are going to fall. There's notes that are created around that. But generally, the way that we invest in structured notes, it's kind of for the medium risk investor. And I think where the demand has come from our client base is you often see people, especially retail investors, that are in an equity portfolio, which is typically a high risk portfolio, and they start to get nervous that the market's getting toppish or their stocks are getting a little bit overextended, and they decide to sell out and they go to cash. And they've literally moved themselves from the highest end of the risk spectrum to the lowest end of the risk spectrum, and without realizing that that's a huge swing in your risk profile. Why did you do that? You can just gradually move yourself down and say, I want to take a little bit of money off the table by creating a little bit of capital protection in my portfolio. And it's a far more sensible way of maintaining investments to a market, because I think if anyone who's been in markets will know, it's very difficult to try and time when the top of a market is or when the bottom of the market is. And so many people are talking about, a recession in the US coming up and what's happening with these high interest rates. And, we've had this big run up in markets in 2023, but it's very focused on a few companies that have done well, and they're concerned. But to take all your money back to cash now, what happens if the rest of the market catches up? And this gives you that middle pathway.
And let's talk about that. In terms of structured notes, you make money from them. The bank tells you this is how much you've gained. Can you immediately withdraw your money? What are some of the mechanics around moving your money from a structured note?
Sure. So it's a good question. So it depends on the note issuance. So normally if the notes are issued on the JSE, there is liquidity in the notes as well. You just have to, it'll work on a willing buyer, willing seller principle. So generally you'll go and chat to your broker and you'll say, can you please just go and find out if anyone else wants to pick up my side of the credit note. It doesn't have an active market like you would have on a stock. Something like MTN, it's trading all day. People are buying and selling all day, so there's always buyers and sellers. The ETFs, on the other hand, they have market makers on them. So an ETF will have a professional sitting on both sides creating liquidity for you. The structured note, you will have to speak to your broker and just say, I've got 100,000 Rand investment here. I really need to get out. I've had a credit event in my life. Can I sell the note? They will have to go and find someone to buy the note. Generally, it's very easy to price the notes halfway through, so you can normally find a buyer. But the idea really is that with these products, what you want to do is whether it's a 3-year term or 5-year term or a 1-year term, because there's all different terms, you want to try and commit to that specific time horizon.
And the difference between offshore versus local structured notes, do we have stronger notes than the international market? I'm being ambitious, yeah.
Stronger notes. Unfortunately, many of our banks, we take the sovereign's credit ratings. So do we have it from a credit risk point of view? Probably not, but there maybe is a bit of a mispricing there, because I do consider our banks very, very strong. At the same time, because of that lower credit rating, they generally do have to have higher returns. So you do get some very, very exciting return profiles in the South African market. In terms of variety, though, our market is still very, very young. So the quantity of structures that you're going to get here is far less than you'd get overseas. So if you've got a very specific view that you want to express, and obviously you don't have the 10 million to go into a single note, which is even if you're going to put 10 million in a note, remember, each note itself should be part of a diversified portfolio. So you probably need 100 or 300 million. so it is something that a retail investor will be buying off the shelf. And then in the offshore market, you're going to get a way wider variety.
And offshore, getting into that market, are there any regulatory things that you have to look at as someone willing to invest?
From a regulatory point of view, you've got South African exchange controls, of course, because to invest internationally, you're going to have to use your 1 million single discretionary allowance, or you're going to have to, you obviously go and apply for the AIT PIN, it's called now, and you're going to have to do the foreign tax clearance certificate, because you are going to have to use international cash to buy that. So they are the normal exchange control regulations, and then you have to have a custodian as well. So generally, when we do structured products for clients, we offer the custody as part of the package. But if you have an international bank account, they can, or international brokerage account, most of them can trade notes directly into it. But you will need to just check that they can custody the note essentially. But most of the big international players in the South African market that work specifically with South Africans offshore, most of them are geared up to hold these kinds of products.
Well, that was the word on structured notes. Good lecture there from Gary Booysen, the director at Rand Swiss, who was the investment school headmaster today, really unpacking a complex investment tool in structured notes. I hope you were writing down all those gems and notes to try and make more money in your investment.